Morning. Feel free to come more forward so that we're all comfortable with each other. I'm Jill Hoffman, and I've been asked to moderate this session. I'm very pleased to introduce you to Bruce Porteous. He is the investment director at Aberdeen Standard Investments, and he's come all the way from Edinburgh, arrived just yesterday, so his flights were delayed because of the typhoon. So we're very pleased that you were able to make it safe and sound. His background is an actuary, so he chose actuarial science as his career. Back when he was a young lad, he always enjoyed math and was quite good at it and decided to study that in school. And that's led him on a very diverse and interesting career. So with no further ado, I'll introduce you to Bruce. Thank you.
Okay, thanks very much, Jill. Conscious in terms of competition, I'm up against Tencent this morning along with the other work streams, so I think it explains the relatively small crowd, but hopefully I'm going to say something which is of interest to you. As Jill said, I arrived yesterday and my planes were delayed, so I feel okay in terms of jet lag, but if I begin to flag, please be gentle, so thank you. Okay, so here's my agenda. I'm going to talk about, just as way of a backdrop, the challenges that our industry is facing. Then a sort of schematic on how we think about managing value and profitability before moving on to some investment ideas that we're seeing traction, if you like, with some of our some insurance clients that we work with. Okay, so challenges. This chart is taken from a survey we did last year, and it shows, if I just pick on one country, South Korea, for example, we got the rate of return that insurance companies say they need to meet their promises and guarantees, this bar here. The rate of return they're earning on their assets at the moment. And the next bar is the rate of return they expect to earn going forward. And then finally, we've got the risk-free rate of return in that particular market. So you can see, certainly in South Korea, there are challenges in that insurance companies are not earning enough to pay for the promises and the guarantees they've made to their customers. If we contrast that with Hong Kong, a slightly different story in that insurance companies in this market are saying they're currently earning enough to meet guarantees. They expect that to actually get better going forward. But if you contrast that with the risk-free rate of return of 1.6, the gap looks pretty large. So I think it's a little bit of a credibility issue there in terms of Hong Kong. But essentially, the story really is insurance companies are struggling to earn the returns they need to meet the promises and guarantees they've made to their end customers. So, if you like, that's the first challenge. And this is a survey we did last year, and this is what the insurance industry told us in each of those markets. So it's okay. Okay, so this is what the industry itself is actually is saying. From the same survey we asked about regulation, obviously there's waves of regulation hitting our industry. RBC type regs, accounting IFRS 17. In Europe, we've had Solvency II. When it got implemented at 116, we thought, that's it, the worst is over. But in fact, it's just continued to change and develop, and we've now got ICS coming along as well. So it just feels never ending. And again, we asked insurance companies in the various markets, how is regulation a challenge to the way you make your investment decisions? South Korea, again, is another good example because for every company we spoke to in that market, every single one said regulation is causing them problems, both on the solvency side, the RBC side, and also on the accounting side. Hong Kong was slightly interesting because the companies here seemed a lot less concerned. I think if we'd done this study this year or more recently, you'd get much higher yes bars, if you like. So at least at that time, the Hong Kong industry seemed fairly relaxed. Possibly maybe complacent might be a better word. And then another interesting feature is China, where China they've already got CROS in place, so they were less concerned about on the solvency side. But much more concerned on the accounting side because obviously IFRS 17 is coming into that market also. So really, we've got these twin challenges of low interest rates and also these kind of waves of regulation coming towards the industry. Looking outside the industry, there are challenges too. So looking at the banking sector, I'm thinking about Japan here. What we see in the Japanese market is that the Japanese insurance companies are still trying to compete against banks who offer short-term guarantees on the deposits. The Japanese companies are offering long-term savings products with relatively small guarantees in order to compete with the banking sector. But actually, even though those guarantees are low, they're still not actually affordable. However, the companies up there think in order to compete against the banking sector, they're having to continue writing this sort of non-sustainable business. We've also got challenges on the distribution side. The agency distribution models are subject to a lot of challenge around fair value in this environment of low interest rates. Are there relatively high amounts of commission that agents still earn? Are they actually affordable? And as we're moving more towards conduct type regulation where there's more openness, more disclosure, it feels like these agency models are subject to challenge. And also we have the fact that the customers increasingly prefer a sort of digital interface, or at least some component of a digital interface when they engage with an agent or an insurance company. We're also seeing around the world traditional insurance sort of being pushed away, if you like, more in favour of what you might call more asset management, wealth management types of products. And there's a feeling that at least for the smaller and the medium-sized insurance companies, that if you're competing against an asset manager or wealth manager, your investment expertise may not be up to the mark compared to these professional asset managers. So as insurance moves away from traditional guaranteed life insurance type products more towards asset management, wealth management, it's going to be harder for not thinking of the big companies here, but certainly who've got big investment departments and lots of expertise. But maybe the smaller players, the medium-sized players, it's going to get harder to compete against the asset managers. And then finally, the big really unknown, I think, is technology. Obviously, those of us who've worked for insurance companies who've been around for 100 years, we know that we've got legacy systems. Our data is maybe not up to scratch. So the technology firms are better there. Their IT's better. They're better at digital interfaces, real-time decision making, use of artificial intelligence to reduce costs, all for the benefit of the customer. So it feels like really no one has cracked it yet on the technology side, but it feels like it's just a matter of time before someone does, and it's going to be quite tough for insurance companies to compete against these guys. The one that I've heard a lot about and people talk about is Zhong'an, the Chinese company, which has been quite successful in writing a lot of business in very innovative ways. But as I understand it, it's still not that profitable from a sort of finance point of view. But again, it just feels like it's a matter of time before the technology companies really come in and start taking serious market share off our traditional insurance companies. Okay, so I just wanted to look at the consequences of these challenges that are facing our industry, because they are there and they're quite significant. Possibly the change is happening fairly slowly, so you don't notice it. But just picking out a few things that I've noticed. Certainly in China, we saw Anbang writing very, very large volumes of short duration, high guarantee life insurance business. And they were backing that business with illiquid, longer duration assets, stoking up all sorts of liquidity risks in the market. Eventually, the regulator stepped in and stopped it. The Anbang chairman is, I think, now in prison. We've got new ALM rules in China, in addition to CROS, which are designed to make companies get better and more professional at ALM in terms of matching assets and liabilities. And we've had a merging of the banking and the insurance regulators in China with the ex-chairman of the CIRC, I think also in prison, as I understand it. So there have been sort of consequences, if you like, of this behavior by Anbang, which was very much driven by the low interest rate environment in which we're operating to try and earn returns to meet the promises that they've made to their customers. I think in USA we're seeing a bit of a trend where sort of private equity backers of financial services group are coming in and they're acquiring life insurance companies that are in distress or struggling, and as a part of that transaction, the acquirer gives the assets of the insurance company to an asset manager within the same group, who's potentially more expert at alternative type investment, maybe a little bit better at the risk and capital management side of things than the insurance company's own investment managers and risk people. And the argument is that they can extract more juice from the orange, if you like, than the existing management of the US insurance company. So there is a bit of a trend in the US of, say, private equity backers coming in and trying to create value by more innovative, more potentially aggressive investment strategies. Then in Germany, we've seen Generali, one of the biggest players in that market. Actually, it's already sold its traditional life insurance business to a private equity house. So Generali going forward in Germany is going to focus very much on protection type business and also unit-linked business. And again, it's a consequence of low interest rates, high guarantees, new RBC type regulations like Solvency II, which are very, very capital heavy in the German market. So it's persuaded a big player like Generali to exit its sort of bread and butter business, if you like, in that particular market. Okay, and then still on the consequences, looking at the UK, we've seen the company that I work for, Standard Life Aberdeen. I work for Aberdeen Standard Investments, which is the investment business within the wider group. But we've recently just sold our European insurance business to a company called Phoenix, which is a consolidator of life insurance companies in UK and Europe. So again, the argument was we felt that insurance in Europe, it's a capital-heavy business. It's a difficult market, and that there's more of a future, if you like, in asset management, which is capital light. But I think the Phoenix transaction is quite interesting in that the view is that Phoenix can extract value from the books of business that they acquire just through economies of scale, by being bigger. But also by being better at risk and capital management than the existing management within the companies they acquire. As part of that transaction, we've got a strategic relationship with Phoenix, so that we actually manage pretty much all of the assets of the Phoenix consolidation vehicle. And it's not guaranteed, but every time they make a new acquisition, every time they buy a new company, either in UK or in Europe, the expectation is that we will get the assets back to manage. So if you like, Phoenix, this consolidation vehicle, has become a distribution channel for the investment business within Standard Life, within Standard Life Aberdeen. And it's a trend, it's a model that we're starting to see other people look at and potentially follow. Next one is Prudential, obviously very, very well known in the Asian markets, but again, it's public that what is happening with Prudential Group is that they're splitting off the UK business from the Asian and the US businesses, partly to take Asia and USA out of Solvency II, although I guess it's just a stay of execution, if you like, because as the RBC regimes in Asia sort of catch up with Solvency II, the benefits of being outside of Solvency II may not be as big as they are currently. But their plan is very much to take the UK business, split it off from the rest of the business, and they're going to convert the UK business into an asset management business, very, very similar to what my own company has done. And the final example, I guess it depends how old you are, but Equitable Life is quite an iconic name in the UK market. It's a company that got into trouble a few years ago, but it's still there. It's close to new business, but it's actually the oldest mutual life insurance company in the world. I think it was founded about 300 years ago. But it's finally decided to sell itself to another consolidator of insurance businesses in the UK. And as a sort of requirement of that transaction, the existing with-profits customers, which are the customers with the guarantees, they're being required to switch their policies from with-profits to unit-linked. And the upside for them in doing that is that the surplus which is in the company, Equitable Life, which is backing the Solvency II capital requirements, it's going to be distributed to those customers when they transform from with-profits policies to unit-linked policies. So in a way, it's a kind of quite a milestone in the history of this iconic company, in that they're finally throwing in the towel, they're giving up on guarantees, giving up on mutuality, and are selling themselves to a consolidator of life business. And the customers are no longer going to have the benefit of guarantees. They're going to be unit-linked customers going forward. Okay, and then the final piece is one more relevant to here, Asia. I think what we see is that a lot of the European groups are beginning to withdraw from some of the Asian markets because they have to run their businesses at the level of the group according to a Solvency II type model, which is very, very capital heavy. So although the capital requirements of that business may not be reflected locally under local regulations, the level of the group, those companies have to hold relatively high amounts of capital, and therefore it's very, very difficult for these European players to compete against domestic players. But as those companies withdraw, what we're seeing is, Asian investors coming in. They value the licenses, the life insurance licenses. So they're wanting to buy the companies for the licenses and to try and convert these old insurance companies into more modern, new digital insurance type models. So that's something we see in this market. I'd be very interested to hear what people in the audience think of that particular trend. Okay, so I've given a bit of background and context, and I've tried to describe some of the consequences that we see actually happening of the big challenges that our industry faces. I'm now going to talk a little bit about a sort of schematic that we use to think about how to manage value and profitability. So if we look at this slide, we think about drivers of value according to these three discs: asset allocation, modernizing regulation, and risk and capital management. And I think the point is that if you're in any of the discs which overlap with each other, if you're in this section here, for example, you're doing asset allocation, so you're doing okay on optimizing returns, you're complying with regulation, so you've got a compliant solution. But if you're not doing anything on risk and capital management, then you're going to be capital inefficient. Similarly, in the other overlapping sections here, you're allocating assets, so you're doing okay on returns. You're capital efficient because you're thinking about risk and capital management, but you may not be compliant with the regulations, or you may not be ready for the regulations as they change going forward. And then here, if you're in this section here, okay, you're compliant, you're worrying about the regulations as they change. You're doing your risk and capital management, but you're suboptimal in terms of generating returns for your customers and for your shareholders. So another way of describing this, again, just looking at the modernizing regulation disc, is that this feels a little bit like the good old risk complacent days before regulation became risk sensitive. So if you're in this area here, you can take as much risk as you want to try and generate returns through asset allocation. But if you're ignoring risk and capital management, which you can do with, for example, with Hong Kong Solvency I, and with sort of pre-Solvency II regulations in Europe, then you're kind of stoking up risks which are there on your balance sheet, but you're not recognizing them. Similarly here, if you're in this section, if you're doing your risk and capital management properly, if you're cognizant of regulation, that's all fine. But if you're ignoring asset allocation, you're probably being too conservative to survive in this highly competitive market. So we think that these three components are very, very important for the insurance industry, as in this competitive landscape, and as we move more in a sort of risk-sensitive way forward. Okay, So just to kind of summarize that, if you like, we're seeing these trends of companies, and it's driven very much, I think, by modernizing regulation, of companies being forced from this section of the graph into this one here by improving risk management as a consequence of modernizing regulation, and then being sort of forced from this section into this section here. Again, as a consequence really of competition and the requirement to generate as high returns as possible through efficient asset allocation to compete against other companies in the market. So we find this way of looking at things quite helpful, quite useful. Okay. So I'm now going to move on to a couple of investment topics, and these are ideas that I think are driven very much by the first part of my presentation. I say that this move away from guaranteed products, capital-heavy type business models, more towards asset management, wealth management solutions. And also the second part, my second example, is really about efficient management of the back book in respect to kind of legacy with profits business on the balance sheets of insurance companies. Okay. So I think what we've seen is investment guarantees are no longer affordable in many markets. Some companies, some markets have recognized that. Others haven't. Others are still continuing to write the old traditional business, even though it doesn't really make much sense anymore. But what we're seeing is actually a trend of risk transfer away from insurance companies, off the balance sheets of insurance companies, more towards individuals. A fancy name for it is a democratization of financial risk. But essentially, we're seeing risk going from here, from insurance companies, onto individuals. But the issue is, individuals still need to save for retirement, to pay for their families' and dependents when they stop working. And the best way of doing that is by long-term saving in risk assets. So individuals kind of need help in understanding their own appetite for risk, and they also need help in having solutions, investment solutions that meet their needs in terms of managing and sort of understanding risk. And certainly what we're seeing in our business is, I'm not going to talk about lifestyle options today, but we're seeing a sort of huge interest and appetite in risk-based funds, which we feel are very, very, very good solutions for long-term savers who can't access guarantees, but who have got a kind of risk appetite, and they're looking for a solution that actually fits that particular risk appetite. So asset allocation. The point of this slide is to show that it's a little bit tricky. What we've done is by calendar year, we've taken each particular asset class and ranked them by performance in that year. So in 2005, I think we see emerging market equities was best, Japanese equities was second best. In 2008, it was UK small cap. 2008, it was UK government bonds, and so on. So essentially, it's all over the place, if you like, in terms of which asset is best in which year. And the point of the slide is just to show that allocating assets in some sort of efficient or structured way is actually quite tricky, which is where risk-based funds come in. So what I've got here is the past performance over 3 years of a suite of risk-based funds that we currently offer. Sorry, there's a couple of legends missing here. There should be low risk down here to high risk. And the x-axis, it should be the standard deviation of volatility. So on the x-axis, we've got a measure of risk. And on the y-axis, we've got the actual returns that have been delivered over 3 years by these particular funds. There are 5 funds in the range going from low risk up to high risk. And you can see that they're doing exactly what they say they will do on the tin. The performance numbers are pretty attractive, and certainly if you compare these risk-based funds to a comparable index, they perform very, very well. So if you're a low-risk investor, an investor who would like to have a guarantee but don't have the opportunity to purchase that in the market, the type of fund down here is going to be potentially attractive. Okay, and then moving on, I've got the similar graph for 5-year performance figures. Again, it looks fairly compelling in terms of what these risk-based funds are actually delivering for customers. Good returns, but in a very risk-controlled and risk-managed way. And we see this as quite an attractive alternative to guarantees for long-term savers who are saving for their pensions, etc. Okay, in terms of the growth of the business, this chart on the left-hand side shows the AUM for this type of approach. So you can see it's got exponential growth, at least for us, in terms of AUM. So it's probably the fastest growing part of our business. If you look at the chart on the right-hand side, it shows the mix of the funds by risk category. You can see that most customers pick the middle risk tier. There's a relatively small proportion of customers who go for high risk and also for low risk. So most people or their advisors tend to go for the middle ground, if you like. But as I say, this is it's an idea which is sounds simple, but actually the hard part is implementing it in practice, getting it to work, getting the funds to actually deliver what they say they do. And again, it takes time. You need to build up a track record before people have got confidence. Okay. In terms of the sort of process, the investment framework we follow to construct these funds, we start off, by selecting the asset classes we want to include. We then do the strategic asset allocation part of the process, and this part is actually quite actuarial. So we would use stochastic investment models of the type that insurance companies would use to value guarantees, to project the possible asset allocations forward and to identify the efficient frontier and to target those strategic asset allocations which fit the risk profile of the particular fund under consideration. We then do sort of shorter term tactical asset allocation around the edges according to the views of our investment managers. And then we sort of select the funds that we actually use in our risk-based funds because these solutions are actually funds of funds. There's not actually direct holdings in stocks in these particular solutions. Then construct the portfolio and then get it up and running and then review and rebalance the fund on a regular basis, typically quarterly. Again, it sounds like a fairly straightforward thing to do, but actually the difficulty is implementing it in practice and doing it in a way that actually works and is compelling to end customers and to distributors. But we certainly found this is a really growing part of our business. It's a kind of multi-asset type of solution, so it fits very, very well with our sort of other capabilities, if you like. And then just to give you a flavour of the types of asset classes that we include within these risk-based funds. Again, nothing too surprising here. On the left-hand side, we've got what we call the defensive asset classes, and that's typically going to be cash and short-term bonds, short-term government bonds, short-term high-quality corporate bonds. On the right-hand side, which is a growth part of the asset classes that we work from, very much equities across the various geographies. You got real estate investment trusts, and some of the absolute return funds that we have within the company. So really, that was the first example I wanted to talk about, and it's really recognizing that in the sort of fairly harsh environment we find ourselves in, the ability to offer the traditional products is somewhat curtailed and constrained. But as insurance companies, we still need to come up with solutions for our customers who need to save over the long term for their retirement. Okay, my next example is more around management of the back book, the legacy business, which is going to be there for many, many years on the balance sheets of insurance companies. And it's really about the private market assets, which we see as an area where insurance companies pretty much all around the world are looking at very, very closely and starting to put significant flows of money into those assets. I think probably USA seems to be one of the markets which is leading in that particular area. But what we see is, in terms of the provider of this type of financing, in Europe, it's still very much a bank-dominated market. So it's the banks who are lending against these various sort of projects, infrastructure projects, commercial real estate lending, and so on. In USA, it's different. The capital markets provide the majority of the financing here. Canada as well, somewhere in between. But certainly with Basel III coming in, the various banking regulations that are requiring banks to increase the amount of capital they've got on their balance sheets, we're seeing banks starting to withdraw from these specialized markets. And it's creating an opportunity both for the capital markets but also for insurance companies to kind of step in and provide that financing, because it fits very, very nicely with insurance companies' long-term illiquid liabilities in respect of the legacy business on their balance sheet. So why these asset classes are of interest? I think there are three reasons. They generate good yields, which I'll explain in a minute. They're relatively low risk, and also you get good diversification benefits from these asset classes. So if we just look at this bar chart on the left-hand side, it shows the yield pickup versus a comparable public corporate bond. This one here is for commercial real estate loans. So you can see get a pickup of 75 to nearly 150 basis points for investing in these types of assets. And in a low interest rate environment, that pickup is incredibly useful. It makes a massive difference to your balance sheet. It makes a massive difference to the pricing of your products if you're using these assets to back annuities, for example. They're also, if you look on the right-hand side, relatively low risk compared to public corporate bonds. So again, looking at the commercial real estate loans bar, this shows the recovery rate for these asset classes. And you can see that if a loan does actually go into default, there's a much higher probability that for a commercial real estate loan, it'll actually get out of default and become performing again. So we would argue these assets are relatively low risk compared to public sector corporate bonds. And then the final reason for investing in them is around diversification. What we're trying to do here is identify the return drivers for many of these asset classes. And when you've actually done that and you look at the correlations between the drivers, they tend to be relatively low. So if I just pick one example, if we take, for example, student rental growth, where is that one? Yeah, this one here, student rental growth, which is obviously going to be a driver of the profitability, the viability of lending to universities to build accommodation for their students. And we compare that to, for example, the one I wanted to do was, motorway annual flow traffic, number 8, which is obviously going to be a sort of a key driver of the viability, the profitability of infrastructure lending to finance motorways. So if you look at the correlations between those two drivers, it's coming out at about minus 0.4 here. And also, if you look at these drivers and compare them to GDP growth, you're generally getting fairly low correlations. So I think there's an argument that these types of specialized private market assets are not that correlated within themselves, but they're also not particularly correlated with the general economy. And if you can persuade your regulator to recognize that diversification in your capital calculations, then there's a chance that you're going to get a sort of risk-efficient solution here. Okay, so I've talked a little bit about the private market assets, why they're interesting, why they're attractive. In terms of how they're used, what we're seeing in our markets in UK, Europe, and increasingly Asia is that we're quite often given the cash flow liability profile of an insurance book. So it'd be the light blue bars here on this graph here. And the challenge we're given is to construct an asset portfolio which cash flow matches those liabilities, but you have to do it in a sort of optimal way. You have to try and maximize the rate of return on the assets or minimize the risk on the assets, whilst continuing to keep the assets and liabilities cash flow matched. Now we're able to do this. We've got, because of our insurance heritage and our insurance parentage, We've got tools that can actually search through the investable universe to solve that problem, to find asset portfolios which cash flow match liabilities, but to do it by optimizing some metric. It could be maximizing rate of return. Whatever the client wants to do, we essentially think we can build tools to solve that particular problem. And as I say, this idea of cash flow matching, again, it's one of these things. It looks quite easy to do, but actually, when you actually try to do it in practice, it's quite tricky. But as I say, this just idea of cash flow matching is becoming quite a common thing, because it's seen as a way of controlling and managing risk, managing the spread risk on your portfolio between your assets and your liabilities, which certainly under Solvency II, you have to hold capital against spread risk. So if you can sort of minimise that, it's actually quite useful for insurance companies. Okay, the next slide I think I'm going to skip. It's just another way of thinking about the same problem by constructing a sort of efficient frontier and sort of moving around the frontier to try and identify the optimal solution. But I think I'll skip that and move on to my conclusion. So I think pretty much said everything I wanted to say. So just to sort of draw my session to an end, and hopefully we'll get some questions too. I've described some of the challenges that our global industry is facing, and it's leading to a lot of pressure. It's leading to a lot of change around new business models, new ideas for asset classes, and a sort of solutions-based approach to investment on the balance sheet of an insurance company. We've got this theme of regulatory modernization, which is happening pretty much around the world. And as a consequence, the value that insurance companies create for their stakeholders is increasingly being driven by being good at risk and capital management, and by this idea of constructing solutions that sort of fit both the asset and the liability side of the balance sheet. In terms of sort of end customers, we see investment themes around we need alternatives to guarantees, and risk-based funds feel like quite a good approach, getting quite a lot of traction in our markets. And then finally, in respect of the legacy books of business that are, as insurance companies increasingly walk away from that old-fashioned type of business, which is more and more unsustainable, the back book management of those assets is increasingly important. So efficient asset and liability management, cash flow matching, these types of ideas, we see that as a theme, if you like, within our industry. So that really completes what I wanted to say. I think I finished a little bit early, but I'd be happy if there are any questions. I'm sure there's some disagreements in the audience.
Oh, great. There's people showed up. Sitting here at the front, I couldn't see. So it looks like Frank's got a question.
Hi. Limit myself to two. I might limit myself to a couple. Just taking a couple of the charts that you put up, you looked at 5-year returns for those list of funds, and you were talking in a context. Yes, that's the one. You were talking in a context of long-term investment. 5 years is not actually a long-term investment. If you put up something like a 20-year chart for that, it would look extremely different. In fact, it might be flat, because 20 years has seen a very good return in bonds and reasonably flat in equity markets, or a few equity markets. Of course, 20 years ago was the top of the bubble, the info bubble. So 5 years is actually quite a short time frame, especially when you say that, hey, the financial risk is actually being put on the individual now. An individual who's 60 now who's 20 now has a good chance to live to 100, and so we should be looking at an 80-year time frame. And good luck with that one. The second question, the second point.
Shall I respond to that one first?
Yeah, sure.
I think as described through the investment process, I would expect that if we had been running this for 20 years, you would get a similar shape, because the investment process is dynamic. It changes with markets, it changes with conditions. So I think the dynamic nature of the strategic asset allocation process would have picked up the points you've just made. So, I mean, I can't prove it, but I would expect that if we had, run these funds.
Aberdeen's been around for a while. You have 20-year returns on your funds? Anyway, it's, but from the assets themselves, it's I still think that it would be reasonably flat. But long term, this is what we expect. I assure you, but a little bit flat. The second one is looking at those correlations. You made the use of 1-year correlations, but a lot of that stuff there is valuation based rather than market based. And over a 10-year period, it's very hard to come up with accurate correlations. And for things like REITs and other things that might be valued on a valuation basis rather than market based, you really have to look at 3-year returns and look at the correlation of 3-year periods, because we do get large cycles in some of those things. And when you do that, you actually see a very high correlation occurring in many of those asset classes. And so the diversification that you get for a strategic asset allocation is not as high as most people expect. And tactical asset allocation in a lot of that stuff is impossible because of illiquidity. So just I'll let you respond to that one as well.
Okay. I agree. I mean, correlation is a tricky area, just generally, isn't it? But I would say the 1-year look was driven a little bit by RBC type regimes, which are looking ahead over 1 year. I think thanks. We'll take that comment, and I'll take it back to HQ, and we can have a look at it to see whether you're right that these correlations are higher over a 3-year look. Thank you.
I have time for one more question. Okay, I had a question actually. With respect to the increasing regulation and the increased capital requirements, as you said, the risk is moving from the institutions to the individual. Is that good for society as a whole?
Okay, that's quite a tough question, isn't it? I think it's probably bad for society as a whole. But what can we? Maybe annuities in the UK is a good example. So there's an argument that Solvency II, and in particular the risk margin, has killed off the annuity market. So most of the providers have withdrawn from that market. Industry's arguing with regulators that the risk margin is calibrated too high. It needs to be changed, and one reason for that is to make available these products to end customers. So I would say it is bad for society, and we somehow need to get the right balance between regulation, risk and capital, and providing value-adding products and services to end customers.
Yeah, I agree, and I think that's perhaps, I'm going to stop you, Frank. You can get us at the coffee break. I think that's something that maybe actuaries, we should play a bit more of a vocal role. So if you could all join me in thanking Bruce for his informative talk, and I think we have a small gift for you as well. Okay.
On that last point,
Sure.
the Actuarial Society of Hong Kong is having an insight session tomorrow evening at Wong Chai, where that question that was asked by Jill is actually going to be discussed on.
Very good. So I see some people moving in and out. So yeah, so the next session that's going to be here is where cybersecurity meets insurance, challenges presented and opportunities created. You're allowed to stay. Some new people will come in. So you could please take your seats. So we have Joshua Pyle, who's come in to talk to us about cybersecurity and how it relates to insurance. So he currently works for a company called CyberCube. So he's one of those Silicon Valley startups. And he ended up in actuarial science with studying it in school, enjoyed mathematics and economics, and got his first job, his internship at Liberty Mutual. So we sort of ended up in it by accident, as a lot of our stories are going. So please join me in welcoming Joshua to the stage.
Thank you. Good morning. Just as a show of hands, maybe to kick this off, I'm curious how many of you work for insurance companies or reinsurance companies that either write cyber insurance today or hope to in the near future? Okay, a couple. How many of you use technology? More, okay, that's good. I keep saying if we go back to pen and paper, all of our problems will go away, but no one listens to me. So the inspiration for this talk, I started, as Jill mentioned, at Liberty Mutual. I've worked for mainstream insurance companies, mainstream lines of business, auto, home, commercial property, small business. And I joined Symantec about 3 years ago, which is the world's largest cybersecurity company. And it was definitely a learning curve. It was very interesting, but it was fascinating to me how different it was from existing lines. So I thought it would be interesting to kind of relay to you some of the challenges and differences from other lines of business we've been used to thinking about in the past. And so that's what I'm going to try and do today. So indisputable proof right off the bat that this is indeed the best thing since sliced bread. Couple quotes. This is the hottest insurance product that has come out in my 40-year career. Cybersecurity insurance is a very, very bright future for insurers. It fills a gap, a void that virtually every business in America has. But we don't want to get too excited just yet. There is definitely a potential within this line. We know from various sources that estimated annual costs to the economy are over $400 billion, and we cover roughly 1% of that in insurance. We've seen historically large growth. We're going to see even larger growth. We'll see numbers on the next slide, but we're expecting over the next 5 to 10 years that premiums actually will increase by 15 to 40% per year. And that would bring us to $10 to $20 billion, 10 billion by 2020, 20 billion by 2025. Now, 15 to 40% is quite a range, but either way, it will grow drastically. We know that a lot of large companies are keeping this top of mind. If you ask a conglomerate what concerns they have, cyber will probably be in the top 3. So a lot of large companies are thinking about this. They may have a more sophisticated approach. They may be thinking about these things a bit more than small companies. So that leaves an entirely untapped micro, small, medium business segment that we'll see explosion in over time. So specific numbers, we have a couple data points at the bottom, 2008, 2013, 2016. From 2008 to 2013, we actually saw an increase in annual premiums of 11% per year, and we saw that rise to 30% between 2013 and 2016. Historically, this has been dominated by the US. That will change. It was 85%, now it's 80%. We have 10% in the EU, 10% in the rest of the world. As regulation increases, we expect that to drive premiums up. As events occur, we expect that to drive premiums up. So this 80% will become more diversified over time. We have a lot of implemented regulation right now, EU GDPR, there's regulation in Australia, Canada, other parts of Asia, Singapore. And that should kind of drum up interest, get people thinking about these things. And the other stats I kind of went over. So we expect this to be growing rapidly. So we want a part of this business. Historically, it's easy to understand why. This is 2017. If we looked at 2014, 15, 16, we would get a similar view. So what do we see? This is standalone versus package versus total. Well, we have loss ratios right around 30%. We throw on expenses and voila, 61% combined ratio. What could possibly go wrong? So a little anecdote about one of my previous employers, which I won't mention by name. Back in 2000, they were a heavy writer of workers' comp. So they made the bold decision, given historical profitability figures, to not double, not triple, but increase the size of their book tenfold. What did they gloss over? That could be good, that could be bad. It went south pretty quickly. One thing they overlooked was the regulatory aspect. If you guys are familiar with workers' comp, you surely have heard of life pension, and you understand that there are certain cases where you may lose an arm, a leg, you're permanently disabled, and a workers' comp carrier would essentially have to cover you for those medical payments for the rest of your life. So this carrier increased the size of their book tenfold, and things went south really quickly. What's the relevance? We want to make sure we're not doing that here. There are 170 companies in the US that write cyber insurance today, but they don't use analytics. There's no data behind that. So we want to make sure that we're thinking about this very different peril in the right way so that we're doing this responsibly, because these 60s could go up pretty quickly. So where is this demand coming from? We think about the way our world is changing. We have connectivity everywhere. I jokingly ask if you guys use technology. Of course you do. You're surrounded by technology. We have now smart watches, smart home thermostats. Our cars are connected. We have robotic vacuums. We have, I always joke, if you guys use Fitbits or Apple Watches, that people are wanting to run their dishwasher from their Fitbit. And so we have, especially in Silicon Valley, a culture of innovation, innovation, innovation. It's cool, it's neat, it's trendy, but is it secure? So there's this demand for constant connectivity, and as we move into that realm, we have to be very careful about the perils that that presents. So stepping back, what's the relevance to the insurance industry? I'm just this is a general linear framework for how we would think about writing insurance. Most of you are familiar with this, so I'll kind of go through fairly quickly. But we want to start off by asking, what is our company about? Do we want the cheapest insurance? Do we want the best coverage? Do we want animals to be the mascot? And then we underwrite. We have individual risks coming to us asking for insurance. We say yes, no, we look at their exposure, in this case their security, what are their terms and conditions, and then we would attach a price to that. So now that we know more about that entity, we can attach a premium. Once we bring those policies on board, we all of a sudden have this idea of aggregation. So what would a catastrophe look like? So we want to think about our exposure and how it's accumulating across different dimensions. Now, this brings up immediately several challenges from the cyber realm. Those we'll go through in more detail for each one of these, but I'll mention them here still. We have a dynamic threat landscape. This changes every day. You guys hear about this in the news, different types of attacks that are happening, different vulnerabilities that exist. How can we stay on top of that? That ties in very closely to the human element. We're not worried about hailstorms, damaging cars. We're not worried about super typhoons. But we are worried about thinking entities. How can we play this cat and mouse game? That person on the other side has a strategy, they have an intention. So how can we be privy to all of those details? We have a severe lack of data. That's something we just universally complain about as actuaries. We never have enough data. But even if we did, would it be relevant? Given that this peril changes so quickly, would 60 years of information be relevant? I wouldn't necessarily want to look at 1960 cyber insurance information and assess what ransomware looks like today. We have a lack of domain knowledge. So I'm thinking from an actuarial standpoint, from a company standpoint, given my background, I came again from auto, home. We can't just put people who have worked on other lines in the cyber slot and hope that everything works out. I've now been studying this realm for 3 years. I still feel like I know nothing. It's a lot to learn, and there's a domain gap there. So it's important that we bring in cyber experts when we're pricing this. This is a very small regulatory and legal environment. We'll go over some of the different regulations that are being put into place right now. And again, the parallel back to the workers' comp story, we want to make sure we're not setting ourselves up for something that could be eventually destroyed by different regulation. And then adverse selection, always a problem, but how about in this case? The company knows their security posture sometimes. They know what their training looks like. They know what their infrastructure looks like within the company. They know how their networks are structured. So would it be more likely that a company would buy insurance if they know they have poor infrastructure? I would think so. So what does cyber insurance even cover? I think most people envision this fourth column: hacking, viruses, denial of service. But it's actually quite a bit broader than that. It could be covering advertisement, personal injury, libel, slander, copyright infringement. It could be covering E&O, D&O. It could be covering breach of confidentiality. So it's broader than most people envision, and yet we still end up seeing a whole lot of this across these companies. I mentioned these 170 companies that will grow. I've talked with major carriers, leading carriers, who have kind of given portfolios of information, and we're thinking about which risks cover or which coverages are applicable for different risks. And a lot of times the answer is, not really sure on this one. I don't know if it has business interruption. I don't know if data breaches are covered. People don't even know what they're writing. So how can we bring standardization across 170 companies when there's no uniformity in how policies are being structured, the coverages being used, the language being used, the exclusions, the endorsements? It's all over the map. So if one day you wake up and a ransomware attack happens, are you covered? I guess we don't know. But it gets worse because we have policies structured specifically for cyber as a standalone peril, and then we have all of these other potential coverages. Now, we weren't thinking about computers that much when we structured the policy language from 25 years ago. So we wrote a property policy. We were maybe a little bit loose with our exclusions. Maybe we consciously added endorsements on top of existing policies. For whatever reason, you see here just a sample of other lines of business that could be impacted. Now, I stripped out the attack scenarios on the left for obvious reasons, but we're going to have impacts across standalone cyber, property, auto, workers' comp, D&O, E&O, business owners, GL, marine, life and health. So if something happens, again, is it covered? First, depends on the company. Second, depends on the other lines of business you have. So now that 60% loss ratio, I'm looking at it pretty skeptically. We haven't had serious catastrophes yet, but we will. We think back about property with Hurricane Katrina back in the U.S. That was something most companies didn't expect. And so you saw a wave of premium increases after that. And cyber is in that state right now. There will be something catastrophic that happens, and we'll just have to make sure that we're ready, we're resilient, we understand our policies, both cyber and other lines of business that we're writing, because this will affect everybody. So this is a scary slide, I think a fun slide to think about. These are a couple of sample attack types that we would be interested in. I'll go through a couple of them. We hear about industry attacks. So there's a lot of talk right now about what if a hacker were to break into an industrial control system, into the power grid. There's a very scary paper that was put out that objectively was tracking Russian hackers to infiltrating the US power grid. And I was reading through incrementally at the various steps they used, and it just it stands out immediately how sophisticated both sides are to even be following each other. So they're already in there. Nothing has happened yet, but the thinking is they may be planting themselves, understanding the structure, getting ready for something in the future. So what if they blow up a refinery? What if they shut down the power grid? What if they hack into airplanes and crash them into each other, into airports, into something else? Marine, we think about logistics. I have a slide coming up that has a couple of the attacks we've seen in the last couple of years. And it's quite scary when you start thinking about what all could happen. I mean, you have sort of on the left the password attacks. That's what we're used to thinking about. Those are kind of the boring brute force, someone guesses your password. We all have 1,000 passwords now. Are we using the same password? If so, then we're in serious trouble. And you think, for example, there was a breach at Yahoo, and I've heard a lot of people say something like, "It's okay. They got my email address. It's not the worst thing in the world." Okay, so they got your email address. These guys got your phone number. These guys got your address. These guys got your social security number. All this is floating around on the dark web. And there are attempts to try and combine these into a single record for a given person. So all of a sudden, all these seemingly insignificant breaches are quite significant. And for those that don't understand the dark web, we have really 3 layers of the internet. You would have the surface web, which is if you Google, that's what would come up. Then you have the deep web, which is anything that's kind of stored within a website or on a data server. That wouldn't actually come up when you're Googling, but it's there and usually legitimate. And then you have the dark web, which is based on something called the Tor browser, the onion router. And that's a mechanism through which you can maintain anonymity if you're searching for something. So if you're typing in google.com, that will be translated through a domain name system into an IP address that would be then routing you. It's changing it into something the computer understands. The Tor, the onion router, would randomly jump around through, say, 6 different IP addresses so that no one can actually trace that back to you. And because of the anonymity feature on Tor, you have a lot of bad stuff going on there. Illegal weapons sales or trades. You would have child pornography, things that the FBI is trying to investigate, but it's made that much more difficult because you're peeling back these layers of an onion. So what has happened, you guys have surely heard of some of these. I'll kind of go through. The top left is sort of your standard data breach, ironically on a credit monitoring service that was supposed to be reputable. You can imagine how much information a credit monitoring service has on you, so that's fantastic. You have, similarly on the bottom left, if you guys are, well, really probably for any government, you're giving up a lot of information in that process to become an employee of the government. And that's certainly true of working in the US as well. So they go through complicated background screening processes, and there's a lot of information. That database actually was hacked recently as well. You have a couple here that are linked. You have the middle one, which is WannaCry. The bottom right could be Petya or not Petya. It's just kind of generic clip art. But these are different types of ransomware. And if you guys are not familiar with ransomware, it's essentially where an attacker will infiltrate your system, encrypt your data, and force you to pay a ransom before decrypting that for you. In some cases, they don't decrypt it. In some cases, they don't know how to decrypt it. So, you know, you're occasionally paying, crossing your fingers. It's definitely a call to back up your data. And so we've seen a number of conglomerates that were affected by this. FedEx, Maersk, we've seen significant outages from these global companies, and you can imagine the business interruption impact just for a fairly short outage. In this case, it could be that the attackers actually want the ransom. Usually, actually not the case, because a lot of people don't pay the ransom, and it's fairly small. It's something like $300 per machine that they were asking for. So the amount they're getting from that is not that great, but they do enjoy the disruption aspect of it. So even though it seems like they're asking for Bitcoin to you know, gain financially, that may not always be the case. There are other intentions in play. We talked a little bit about domain name service. So Dyn is a DNS provider, and you can imagine if you have a mapping of URLs to IP addresses, that could either be shut down or, quote, poisoned, so that if, for example, you're going to your favorite website, someone has modified the IP address associated with your favorite URL, that will actually reroute you to their own fake version that they've created for that website. So you go on, you think, okay, this is where I wanted to go. I keep saying Google. It wouldn't be as applicable in this case, but maybe something you have to sign in involves financial information. So it reroutes you to their fake version. You sign in. Okay, well, they just have your financial credentials. So it's that easy if you poison a DNS provider. In this case, this was just an outage, so people weren't able to access their websites, but it could be much worse. And then on the top, you have AWS. You guys are obviously familiar with Amazon. And if you can imagine different companies have different reliance on different service providers. There's a lot of reliance on the cloud now, and this is kind of how we have to start thinking about this. If a common service provider goes down, what's the cascaded impact of that? Who else will be impacted? Amazon has such a foothold now that if they go out for a while, there are definitely backups in place. But we're thinking worst case scenario. How would companies respond? What's the resiliency in place right now? The left one in the middle is kind of interesting and very recent. We hear a little bit less about cryptocurrency right now. We had sort of, I guess, a bubble that maybe partially popped, probably not completely. But CoinHive is a mechanism for mining cryptocurrency within a web browser. So there have been attempts to inject code into web code so that this actually will mine cryptocurrency on a user's machine. So you would go to your website, and it would actually be using the resources of your computer to mine cryptocurrency. Again, relatively harmless in that context. CoinHive makes money, the attacker injecting the code makes money, and it's an annoyance, but you can imagine that that could go south as well. This is something where now all of a sudden we have all these different attacks we're thinking about. Now, how are they related to each other? Obviously, this is all part of a larger system. Imagine that I were to randomly choose a computer in here and hack into it. Does that mean that I'm then likely to conduct that same attack on someone else? Or someone else will see me do that successfully and think, oh, I should do that on the same person because they have a weak protection in place? Or would they take my algorithm and use it on an entirely different third party? So you can imagine if there are floating vulnerabilities out there, we have all of these antiquated operating systems. If those are known vulnerabilities, you can imagine attackers are out there finding those and exploiting those, and a lot of the cases on the previous page were that. There's something called Eternal Blue, which was an exploit on an operating system that a threat actor group called Shadow Brokers released after hacking into the NSA, which is a US government entity. And that was related to a Microsoft operating system patch that was released years ago. And so you get these notifications on your phone, and I won't ask for hands on this, but you don't immediately think, oh, I have to patch this, right? I have to update my apps. I have to update my operating system. You think, oh, not again. I just did that. And you have that true of companies as well. So even companies that say, yeah, we're good about patching, we have a good policy in place, not true. They could say we patch within 3 days, and 90% of the time that's not true. So you have these vulnerabilities from antiquated systems out there. People know exploits, and it's just a matter of infiltrating the system. So regulation certainly comes into play here in a couple different ways. We have, I mentioned, a growing effort to introduce regulation around breach requirements. It's especially messy in the US. We've finally this year, I think mid-year, developed our final state level mandate for when you have to report a data breach. That means we have 50 different state level mandates, which is completely ridiculous. You can imagine if you're a conglomerate, you're operating in all 50 states, you have a massive data breach. Now you have to flip through 50 different reports on whether or not you have to notify, when you have to notify, who you have to notify, how. And so there's not really this standardization. I think we're working toward that, but right now, it's a matter of is your data encrypted, who's impacted, how much data is stolen. You're kind of asking these questions and then reading a lot of different reports that don't really sync up. We're seeing EU GDPR, which came out in May, and we'll likely see fines that far surpass anything we've seen in the US that will probably get people to wake up. Those fines could be up to 4% of annual turnover, and you can imagine for any company that would be absolutely massive. And likewise, we're seeing similar regulation being put forth in Australia, Singapore, Canada. I mean, there are a lot of countries now. This is an outdated list, but you can see that as actuaries, now there are a lot of different regulation pieces that are coming into play. We're used to thinking about pricing, rating variables, DOI objections. We're thinking about solvency regulation, profit and contingencies, and now we're introducing breach reporting. So as we kind of go back to all of that regulation thinking, this is increasingly important if we want to make sure we're doing this the right way and we're not just relying on those historical loss ratios. Even how we think about a catastrophe is different in this realm. So with property, there's been a tendency to draw a dollar threshold and say, if the industry loss is above this threshold, then we declare it a catastrophe. That doesn't really work in cyber. You could have one entity that has an absolutely massive loss. Your terms and conditions will probably limit that quite a bit. And we wouldn't really call that a catastrophe. So if it's not a single point of failure, if it's just one company getting breached, we would consider that a large loss, but not really a catastrophe. And so what I'm trying to represent here, rather than using a dollar threshold, we want to think about this from a Cascasian perspective. So what are those single points of failure that so many other companies rely on? And if they were to go out, what are the implications on all of those first tier, second tier, cascaded companies? That would be a catastrophe. Not just if one company is hit, that would be an attritional loss. But if multiple companies are affected by the same cyber attack, that would be a catastrophe. So I would have updated this with some information on the super typhoon, but this is something a lot of people in the U.S. are focused on the coast of Florida. We actually had a hurricane of our own, as you probably know, hitting North Carolina, South Carolina. The interesting aspect of this is when we think about property insurance, we can think of it very geographically. If it's a typhoon, a hurricane, an earthquake, you can almost draw a circle around what you want to limit. That's very different than if this is what your network looks like. What if you have data centers in San Francisco and Dublin and South Africa, and they're connected in different ways, and you have partners and clients and customers around the world? You can't just draw a circle around Florida and say, let's not write so much there. It's more about aggregation across different components, and that comes back to this idea of single points of failure. How are these companies connected? How are they relying on each other? So going back to the human element, I like this picture. It reminds me of a college incident. My roommate in college was a grandmaster in chess. I'm absolutely terrible, but I still played to be fun. And I was very impressed and intrigued at his strategy. And so I asked him one day, I said, when do you know you'll beat me? He said, when I take your first pawn, that's when it's officially over. And I thought, well, it wasn't arrogance. He was talking through why that's true, and it made sense. But the point is, he's so many steps ahead that he knows what I'm going to do. He knows all of the different routes I could take, and he has answers for all of those. And so if we think of these as white hat and black hat hackers, meaning ethical hackers and hackers that are out for no good, then that is a cat and mouse game where they're trying to get as far ahead as possible to know the next step. So just as we're trying to still clean up patches from 10 years ago, they're not sitting idle. They're infiltrating power grids. They're digging around and seeing what they can find. There's a lot of talk right now. Obviously, the U.S. is extremely politically divided right now. We have an election coming up, and there's likely going to be an effort to infiltrate the voting process. So how can we stay on top of all of these different threat vectors, all these different attackers? It comes down ultimately to intention, to resources. There are a number of reasons you could attack. I'll give one example just as a thought piece. There's a company, I don't know if it's here in the U.S., there's a food chain called Chick-fil-A. It serves chicken. It's fantastic, but that's beside the point. They were hacked, and one might look at a chicken restaurant and think, it's not probably the top target, but they have religious affiliations. They're well known for having Christian affiliations, and so that comes into play. Little things like that. What do employees think about working there? People with all the inside information. What do nation states think? So you have these political effects, these internal effects that will play into whether or not a company is actually targeted. So this question is really how we started at Symantec. And you can imagine from the outside, there's a certain amount of information you can glean from sending pings to externally facing machines. So if you are a company, you have a number of computers, you have a number of mobile endpoints. A lot of those are connected to the internet. As an outsider, you can actually send what's called a ping to different ports on that, I'll call it a shield for, because of the clip art. Based on what information you get back from that, you actually have a sense of where vulnerabilities exist in that shield. So that's an outsider view. That's outside-in exploration of data security. Now, Symantec had a unique perspective because they're in 157 countries, they have 250 million machines, and you're able to see what information goes from where to where, who's opening what, who's downloading what, and so you have a sense of industry, you have all this by machine data that gives you that inside-out perspective. So if we can complement the outside-in perspective with an inside-out perspective, then that's a powerful view of the full risk profile. The problem is, as I mentioned before, we don't just have to care about ourselves, we have to care about who we're connected to. So there's another, I'm not sure which companies are here or not. There was a big Target attack, kind of like a Walmart chain. That actually was a result of someone hacking into the air conditioning system. So there was an HVAC unit, someone hacked into the air conditioning unit, moved laterally through the target system and exfiltrated data. So you have to be careful not just about your own perimeter, but everyone you associate with. All of your customers and your clients and your partners and your vendors, that all becomes quite important pretty quickly. This is my last slide. I think we've talked about some of this. There's one actuarial paradox here I think is pretty interesting at the top. If we see someone get into an auto accident, then almost every insurer will say that person is more likely to have an accident again. Now, it may not always be their fault. That is factually objective. But the rating algorithms would mostly account for that increased propensity. So now, from the cyber lens, let's say company X gets attacked. Now, it could be that they truly do just have incompetent people and terrible systems. So if you try it again, you would get in again. Or you would have a case where someone was scared, they woke up, they tried to hire IT staff, they put controls in place, and all of a sudden you have to ask yourself if that company is a safer risk for having been breached. So actuarially, how would we incorporate that into a rating plan? Do we charge less for companies that have been breached? Sort of like larger companies, you would be more likely to attack, but they would also have better defense postures. So another kind of conflicting argument that we would have to weigh, but definitely a complexity that's worth considering. We talked a little bit about the dynamic nature. We just have to make sure we stay on top of what the threat vectors are right now, what people are talking about, thinking about, what the assets in play are, who the threat actors are, what their capabilities are, what their resources are. Are they being sponsored by the government in some cases? And then we do need to move towards standardization. I mentioned the 50 state regulations. We have policy language, endorsements, exclusions all over the map. And that's one thing that CyberCube is trying to work toward. Can we speak the same language? Because this is a problem that affects all of us. As an economy, as an industry, it's an important issue to solve. And if everyone is speaking their own language, it makes it that much more difficult. So with that, I don't know how much time I have left. I'm happy to take any questions.
We've got time for a couple of questions, or we're all going to be busy changing our passwords.
I always jokingly say that I have not slept well since joining this job, and that's partially true.
Yeah, it is kind of freaky. Do we have any questions for Josh? Okay.
I scared everyone.
You
I
did.
guess.
We're all just busy changing our passwords right now and going, oh my God, what about my home computer? And then I liked your story about they came through the air conditioner to get to it. And I was like, it sounds just like an action movie, right? Except for now it's all cyber. Anyways, please join me in thanking Josh for a very informative and entertaining presentation.
Thank you. Oh, sure.